Hey everyone, welcome back to Corporate Decoder, the place where we dig into the nitty-gritty of corporate filing so you don't have to. Today we are looking at Fidelity Covington Trust's latest filing. Think of it like opening a treasure chest, but instead of gold, it's pages and pages of, well, let's just say it will be interesting. In short, this report is a snapshot of how several Fidelity exchange-traded funds or ETFs performed over 6 months, offering a peek into where they invested and how they managed their money. It's from August of 2024 to January of 2025, so what's the story? Which funds are shining and which might need a little extra polish? Let's decode it. We're diving into a shareholder report, which means we're looking at a collection of reports from various Fidelity funds. Each fund gets its own section, and each section gives us key information. We'll see things like what the fund invested in, how much it cost to run, and some basic performance numbers. It's like a report card, but for your investments. Let's start with the Fidelity US Multi-Factor ETF. This fund has a simple goal: to invest in US companies that look good based on a few key factors. For a hypothetical $10,000 investment, your cost for the last 6 months would be about $8. This translates to an expense ratio of 0.159%, which is pretty low, and it helps to reduce costs. Looking at some key facts, we see the fund size is about $24 million. It holds just over 100 different investments. Also, the portfolio turnover is 31%, meaning that the fund is pretty stable and does not change its holdings often. Now, where is the fund putting its money? A big chunk, 30%, is in information technology. Financials are next at 13.6%, followed by healthcare at 10%. So the fund is betting big on tech while also keeping its foot in some of the more traditional sectors. The assets allocation is basically all common stocks at 99.8%. Digging deeper, here are the top holdings: Microsoft, Nvidia, and Alphabet. That's Google, to name a few. These top 10 holdings make up around 30% of the fund's net assets, showing that the fund's performance relies on just a handful of big names. The report is trying to show how diversified it is, but in reality, 30% is tied to just 10 holdings. Moving on, let's check out the Fidelity High Dividend ETF. This one aims to give you income by investing in companies that pay out high dividends. Again, the costs are $8,000 to $10,000 invested, similar to the previous fund. This fund is much bigger with about $4.6 billion in assets. It holds slightly more investments than the multi-factor ETF, with a portfolio turnover is very low, just 1%. Where's the money going? Again, information technology is on top with 25.7%, but industrials are a close second at 16.3%, and consumer staples are third at 12.2%. Energy also makes a strong appearance at 10.2%. This shows a slightly different strategy, balancing tech with more dividend-heavy sectors such as energy. Top holdings include Apple, Nvidia, and Microsoft. However, the portfolio has exposure outside of the United States, with 91.7% in the United States, 4.5% in the United Kingdom, and 2.6% in Japan. Next on the list is the Fidelity Dividend ETF for rising rates, which attempts to pick dividend stocks that will do well when interest rates are on the upswing. The report is very similar to the previous ETF, with nearly identical numbers and low $8 per $10,000 investment. This report has assets of $556 million and a turnover of 2%. Once again, information technology leads, but this time it is more pronounced at 32.6%. And healthcare comes in third at 10.6%, and healthcare comes in third at 10.5%. Top holdings are similar to the high dividend ETF, Apple, Nvidia, and Microsoft. Also, it mainly focuses on domestic companies, with 94.2% in the United States, and then a much smaller United Kingdom, Germany, Sweden, and Japan. Now let's check out the Fidelity Fundamental Large Cap Growth ETF. This one targets large companies that are expected to grow, but it uses a fundamental approach, meaning they look closely at the company's financial health rather than just following trends. The costs are higher at $20 per $10,000 invested, which translates to an expense ratio of 0.38%. The fund is $384 million in size, holds 100 investments, and has a high portfolio turnover of 47%. This tells us that they change positions more than other ETFs. The sector breakdown is also concentrated in information technology at 42.4%, communication services at 16.4%, and consumer discretionary at 15.2%. So this fund is really focused on high growth areas. It also has some exposure outside of the United States, although the vast majority, 93.8%, is in US stocks. Some of the top holdings include Nvidia, Apple, and Amazon. Next up is the Fidelity Fundamental Large Cap Value ETF. So this ETF is the opposite of the previous one. It goes for undervalued companies, meaning it picks large companies whose stocks may be cheap for their actual worth. But this fund has a similar expense ratio as the last one. This one is quite small with a fund size of only $6.6 million. It has a similar turnover rate, around 35%. But unlike the previous ETFs, the investments here are concentrated in very different areas. Financials are the biggest piece of the pie at 21.1%, followed by healthcare and industrials. Looking at geographic diversification, this fund is 94.9% in the United States. The Fidelity Sustainable US Equity ETF only invests in US companies that meet certain sustainability standards. It has a cost of $31 per $10,000 investment, and the fund size is only $4.8 million. This one looks very heavy on information technology, which accounts for 28.4%, as well as financials at 13.6%. United States account for 96.0% and Ireland for just 2.2% of this fund. And finally, the Fidelity Quality Factor ETF. This fund picks companies that show strong financial health and stability. It's another cheap one, costing only $8 per $10,000 invested. The total assets are $1.1 billion. Top sectors include information technology with 29.1%, financials at 14.4%, and healthcare at 11.0%. Top holdings include Apple, Microsoft, and Nvidia. There is also geographic concentration with 98.9% in the United States, showing a strong home country focus. All funds stated that they had no changes and/or disagreements with their accountants. It's interesting to see that there's a recurring reference to information about management fees and compensations being included in item 7. It's a bit odd because these disclosures usually get their own dedicated section, like the section which we don't have in the extracted text. Now let's try to get a sense of where things are heading. Strength of Fidelity has a low cost, which are always appealing. And there are various funds offer targeted investment strategies around dividends, growth, value, or particular factors, which makes it accessible. Also, top holdings include well-known, stable companies. Weaknesses to many funds are significantly concentrated in tech, which could be an issue if that industry hits a bump. While this isn't necessarily a bad thing and a good way to increase returns if those funds are heavily allocated towards technology, any event could hurt those holdings and thus hurt the ETF. Lastly, the financial picture is very similar for most funds, which might be an area of concern if they are mostly doing the same thing. It might reflect that they aren't diversified as much. Overall, Fidelity's ETF range gives investors clear choices, but looking closely reveals potential overlaps and sector concentrations that might need a second thought before investing. So, as always, do your own research and choose wisely. Thanks for tuning in to Corporate Decoder. If you found this breakdown helpful, be sure to hit that like button, drop a comment, and subscribe for more insights into the world of corporate finance.